Hi, this is Matthew Cratter from Trader University, and today I want to talk about how to get a 50% dividend yield. If you're interested in investing strategies, trading strategies that work in both bull and bear markets, be sure to hit that subscribe button. So this sounds a little bit crazy, 50% dividend yield. It's not easy, but it can definitely be done. And I'm going to show you how Warren Buffett did it as just an example of something that anyone really could have done when he did it. So we see, if we look at the Berkshire Hathaway, his latest letter to shareholders, the 2019 letter, we can see that he still obviously owns Coca-Cola. He's famous for for holding companies for a very long time and usually not selling them. He currently has 400 million shares of Coke. He owns about 9% of the company. And if we look over here, we can see that his cost in millions is about, if we translate this in millions, it's about 1.299 billion. So we can just take this cost divided by the number of shares and figure out how much he paid per share approximately. It looks like he paid about $3.25 if you round it up. Now, he bought these shares in, I believe it was 88 and 89. Now, he's been holding it the entire time. Obviously, Coke has been growing its revenues over that time, growing its earnings, and growing its dividend payouts. If we go to Yahoo Finance, we can see that Coke is, in 2020, will pay a dividend per share of $1.64. At current yields, so if we take this price, if we take this dividend, $1.64, divided by the price of Coke, $46.90, we end up with approximately 3.5%. But what is the dividend yield for Buffett, who bought his shares so many years ago? Well, that's fairly easy to calculate. We just take the dividend paid per share divided by what he paid per share, and we end up with a number that is 50%. So Buffett is currently earning 50% a year pre-tax on his original investment in Coke. Now, this is what happens if you hold a company for a very long period of time. So when people tell you should buy dividend stocks and hold them for the long term, they're not saying this because they want you to have low returns or because it's a really boring strategy. They're saying because there's all these historical precedents for this working. Now, what's interesting about Buffett's purchase of Coke, and later in this video we're going to talk about a company that I think could perhaps offer returns like this if everything works out. But what's interesting about Buffett's purchase of Coke, it was I think it was his first purchase really where he quote unquote overpaid. He paid a very high PE. I want to say the S&P was trading at 10 or 12 times earnings when he paid a PE of 14.5, which is quite high for Buffett. And it was quite expensive at those days. But Coke was a growth company back then. It was still growing its revenues very rapidly. And what Buffett realized is that Coke, even though it was very popular in North America and Europe, it still had a lot of room to expand in Eastern Europe. The Soviet Union was going to open up in a couple of years. Asia, Africa. I have mixed feelings about this, of course, because spreading Coke has really spread a lot of health problems as well. But back when Buffett bought Coke, Indonesia, the average person was just drinking 4 Cokes a year. At the same time in 1988 or 99, the average American was drinking 296 Cokes per year. So I think these U.S. numbers have obviously, I think they've probably gone down over time, and obviously the Indonesian numbers have gone way up. But Coke was a growth company at this point. You were paying a higher PE, but you were paying that PE for growth. And so Buffett had a very long runway, and hoping he would live a long time, would be able to hold these shares of Coke for a very long time and benefit from the slowly rising dividend. Now, there was nothing very exciting about this, but it really did become Buffett's, I would say, his iconic investment. And very few people realized it was sort of a growth stock play for him. Now, if we look at Coke today, people confuse what worked in the past with what will work going forward. So now Coke has I think as of today we saw it's got a dividend yield of about 3.5%. The dividend's gone up since this value line snapshot was taken, and the price is roughly where it was. But if we scroll down here, we can see this is just a free value line that I'll link to that you can get online, a free PDF. But if we look, they've got an interesting number at the bottom here where they take the total amount of dividends paid divided by the total earnings. So you can take dividends per share divided by earnings per share. And we can see here that as of 2019, Coke paid out almost 75% of their earnings in dividends. This is a sign of a very mature company, a company that does not have a lot of investment opportunities going forward. Coke would not be paying this out to shareholders if they could reinvest their earnings in sort of the way that Amazon does now, or Facebook does, or Tesla does. When Tesla has earnings, they could not do that. So they tend to, mature blue chip dividend stocks like this tend to pay out a higher percentage of their earnings. If we look at a company like Apple, they're probably only paying out 25% of their earnings as dividends. But these sort of mature blue chip stocks are not. And if we look at, we can see their revenue growth. If we scroll up here, we can see that. Well, I'm not seeing it at the moment, but if we can actually look at their sales per year here. We can look at sales per share, and we can see even sales per share has sort of been stagnant. As in 2011, they had about $10 sales per share. It's actually fallen over time. It stayed flat for a while, and as of 2019, they're estimated to have about $8.65 sales or revenues per share. So this is not. This is no longer a very quickly growing company. Actually, I just found it over here. Here are the annual rates. So for the past 10 years, Coke has grown their sales at just 3.5%. Past 5 years, their sales have actually shrunk, and they've grown their earnings at about 4% a year, and they've been growing their dividend payouts at 8% a year. So this is obviously not sustainable. What they've basically been doing is paying out an increasing percentage of their earnings as dividends because they're not finding reinvestment opportunities. They've tried over the years to invest in various things. They bought Odwalla Juices many years ago, but nothing has really been able to move the top line too much. They have done some sort of renegotiations with their bottlers and tried to increase their margins even as sales have fallen. We can see their operating margin, for example, here has finally been moving up in the last couple of years, about 34% up from the high 20s. But Coke is no longer a growth company. When Buffett bought it, it was a growth company. So this is a key if you want to do the kind of dividend investing that Buffett has been doing or was doing earlier in his life. If you're a retiree, maybe it makes sense to just park your money in Coke and make 3.5% a year, and you're satisfied with that because you've already grown your capital for the last 30 or 40 years. But if you want to become wealthy, if you want to grow your capital, you do not want to invest in stocks like Coke that have very slow revenue growth, slow earnings growth, even though they have decent dividend yields from here. So how can we apply this to real estate investing? And after we do this, I'm going to show you a stock as well. I just pulled up a random example. I do some of this, so I'm familiar with the numbers, but you can buy, let's say we buy a house today, and it's about a $300,000 house. I imagine this is a little bit above where the median house sells for in the U.S. right now. Sort of kind of an average house, maybe in somewhere in the Midwest. Pay $300,000 for this as an investment. And I'm going to do a cash-on-cash yield here. I'm going to assume that you have the cash, that you don't need a mortgage. And let's say that the starting rent is $2,300. Now, in many cities, you can still get rent increases of about 5% a year, which is why it's very important to own your own house if you can, because you can get really eaten alive by these rent increases. But let's say that your starting off rent for your rental here is $2,300. You're going to hold it for 25 years. You have about 25 years to retirement. And let's say that you can increase the rent 5% a year. Well, after 25 years, the monthly rent, if I've done this correctly, and I think I have, and this is obviously rental increases once a year, 5%. The monthly rent will be $7,788 roughly. We multiply that by 12, we're bringing in about $93,000 per year on our cost basis of $300,000. Now, I'm obviously ignoring things like depreciation and property taxes and insurance and maintenance, but this gives you a rough idea of cash-on-cash numbers. You're basically earning a 31% return on your money after 25 years. So this is the kind of thing you should probably pass on to your kids, and they can keep your low cost basis essentially. Actually, they'll probably have a stepped up cost basis, but that's a discussion for tax professionals. But this is just another example. This could be the way that you or I do Coca-Cola, where we're betting on inflation and rent, and we don't really have to have a view on whether some companies could have more sales in Asia or Africa, but we can do it at home wherever we live in our neighborhood and really benefit from this sort of persistent inflation. And again, this is a good demonstration of why, if you can make it happen, you should really own your own house or condo instead of renting. But here's a way, if we said Buffett's earning a 50% dividend yield, this is sort of like a gross yield before property taxes, etc., but about a 31% quote unquote dividend yield or rental yield. So that would be one example of how to do the same thing in real estate. You don't need any special expertise. You just need the capital, and you also need to have kind of a feel for how these things work in your neighborhood. But let's look at a stock that has potential. This is a fairly speculative stock, but this could be a good example of how you buy a stock before it's paying dividends when it's still growing very rapidly, and then eventually benefit from a dividend. So traditionally, colonoscopies are a way of screening for bowel cancer and intestinal cancer. It's not a pleasant procedure. Those of you who know something about this can attest to that. And so this is basically a surgical procedure. You need to be knocked out. I won't go into all the details because I don't want to have YouTube dock me for it. But colonoscopy, no one likes them. There's a company called Exact Sciences that has a new product, relatively new, called Cologuard, where it's basically like a poop test that you do at home. And it's not perfect, but it's it seems to be a decent way of screening for colon cancer without going through the horrors of colonoscopy. So the company that makes this, that's developed this test, is called Exact Sciences, trades on the NASDAQ under the ticker EXAS. We've talked about this before in previous videos. Currently has a market cap of about 13, I'd say closer to 13 billion. They're still losing money every year. The last 12 trailing months, they've lost 78 cents per share. And so this is a company that if we go and look at their financial statements, we should see very strong revenue growth. They've gone from, these are actually quoted in millions, so 265 million in revenues in 2017, up to 454 million, and then the last 12 trailing months up to 1 billion in revenues. We can see that they still have an operating loss. They've had this the entire time, but at some point, presumably, if they can make this work, they can have a very high revenue growth combined with a decent margin project and good earnings. So here's an example of revenues have really gone up 4x over just 3 years. And so these are the kind of companies that you want to look at. This is probably riskier than Coke was when Buffett invested in it. But depending on your expertise, certainly if you're an MD and know something about this, you'll be better. You're better positioned to judge the future prospects of Exact Sciences. But if you're looking forward, looking to the future, looking to make wealth, think of companies and products that still have a lot of market share to take, can really spread geographically, and have years and years of growth ahead of them. Eventually, this company, it may be bought by a larger medical devices or medical testing company, or it may eventually begin to pay out a dividend as they just sort of monetize their product. And as the world's population ages, a lot more people will obviously need colonoscopies. So this is an example of if you're already a retiree, something like Coke at a 3.5% dividend yield might make some sense. But if you're looking into the future, if you're someone like Buffett who wants to really grow his wealth over 30 years or 40 years, as he was planning in the late 80s, you want to look at companies like Exact Sciences. It's sold off quite a bit really since its highs of last summer. And so depending on your view of this, and again, if you have expertise in other areas, in maybe in restaurants or in food manufacturing or future software projects or space travel or whatever it is, electric cars in case of Tesla. You can put that expertise to work to try to find companies like Coke in the 80s or Exact Sciences in the 2020s that have a very long runway, can grow their revenues, take market share, and eventually give you a 50% dividend yield on your cost. Now, if you'd like to learn more about how to analyze financial statements and really learn the language of accounting and financial statement analysis, you can check out all my online courses. The course that would probably make the most sense, given what we've been talking about here, is this financial statement analysis course. You can click on any of these boxes to see the list of lectures. I also have a course here on real estate investing. If some of those terms I was using didn't make sense to you, you watch this course and you'll know exactly what to do. If you're interested in crypto or Bitcoin, I have a course on that as well as bear market trading strategies, a couple courses on options, futures, and then of course my flagship course, Learn to Trade Stocks Like a Pro. If this is something that interests you, the good news is that you can get unlimited access to all 13 courses for just a low amount of tuition. So I'll stick a link in the description notes below, and you can click right here where it says Get It Now. Before you do that, you can click on any of these boxes, see all the lectures, but then you click Get It Now. It'll take you to this checkout page. Normally 30-day tuition is just $125 for 30 days access, but I want to give you a coupon code because we're in a recession, and you just click have a coupon code and type in YT as in YouTube 99. Click update, and that'll take $26 off, so you only have to pay $99 for 30 days access. Again, that gets you access to all 13 courses. You can watch them all in the first month, take notes, and then cancel before your subscription renews, and you won't be charged again. No long-term contracts or anything like that. And if there's something missing from Trader University that you'd like to see me make a lecture or course on, you can just let me know, and I will make a course just for you, share it with everyone, and this way I hope to really make this the best resource for traders and investors on the internet. Especially if you're still in lockdown or shelter in place, this is a great opportunity for you to really invest in yourself, learn how to trade, learn how to invest, rather than spending too much time binging on Netflix or anything like that I'm certainly tempted to do at times as well. Hope you guys found this video helpful. If you did, hit the subscribe and like button, and let me know your questions and comments in the comment section below. Thanks a lot for listening. Hope you guys are all doing well and staying well, and I'll see you in the next video.